California's housing market is shaking, and not just from earthquakes. In 2025, some of the Golden State's hottest cities are cooling fast with home prices sliding, listings piling up, and buyers finally getting the upper hand. Which cities are seeing massive inventory spikes? Where are sellers slashing prices like it's Black Friday? And could your dream home be about to drop $50,000 in value? From tech hubs to beach towns, in this video, we're diving into the 10 California cities where home prices are expected to crash in 2025. Don't forget to subscribe to Global Lens for more insights into real estate, economics, and global living trends. Chapter 1. Los Angeles. Los Angeles has always been California's showcase, where Hollywood mansions overlook the Pacific and suburban tracts stretch for miles. But behind the glamour, the housing market is shifting. According to early 2025 reports, median prices across LA County hover near $850,000, yet several neighborhoods are seeing declines of 2 to 4%. For $1 million home, that equals losses of $20,000 to $40,000 in a year. The bigger red flag is supply. Inventory is up more than 50% year over year. In January 2025, over 40% of listings had price reductions, nearly double what was recorded 2 years ago. Even popular mid-market areas such as Northridge, West Adams, and Eagle Rock are softening. High interest rates remain the biggest barrier. A 30-year fixed loan at 7% pushes monthly payments above $5,500, compared to $3,800 just 5 years ago. Add California's property taxes and rising insurance premiums, and ownership is increasingly out of reach. Insurance is especially troubling. In wildfire-prone areas of Los Angeles County, major carriers like State Farm and Allstate have scaled back coverage, forcing homeowners to rely on the expensive California Fair Plan. That adds hundreds, or even thousands, to annual costs. Historically, Los Angeles has experienced boom and bust cycles. After the 1990s recession, values dropped sharply. Following the 2008 crash, prices fell by more than 20%. Analysts do not expect a collapse of that scale today, but they warn that the combination of high rates, climate risk, and slower job growth in entertainment and media may push LA into one of its toughest corrections in over a decade. Chapter 2. Stockton. Stockton is often described as a barometer of California's housing health. In 2008, it was one of the hardest hit cities in the nation, with prices tumbling more than 50% and the city itself declaring bankruptcy. Today, Stockton faces new headwinds. Median prices peaked near $480,000, but have dipped roughly 3% in recent months. Inventory has jumped 45%, while average time on market has stretched from 27 to 44 days. Nearly 38% of listings are showing markdowns, far higher than the U.S. average. Much of Stockton's pandemic boom came from Bay Area workers relocating inland for affordability. But as companies push staff back to offices, demand has slowed. Stockton's unemployment rate is about 7% above the state average, and wage growth has lagged, making it difficult for locals to compete in the housing market. Insurance and tax burdens are also increasing. Combined with mortgage rates near 7%, monthly payments have pushed many buyers to the sidelines. Younger households are waiting, expecting deeper discounts later in 2025. Analysts note Stockton's history of exaggerated cycles. When the broader California market cools, Stockton often crashes harder. While not at 2008 levels, early 2025 indicators suggest the city could see some of the steepest price drops in the state by year's end. Chapter 3. Riverside. Riverside, once considered the affordable gateway to Southern California home ownership, is showing signs of fatigue. Median home prices stand around $575,000, down about 2.5% from 2024. Inventory has surged nearly 50%. And 36% of current listings have markdowns. At a 7% mortgage rate, payments exceed $4,300 a month before taxes and insurance. For many Inland Empire families where wages are lower than coastal counterparts, this is unaffordable. Riverside's boom years were fueled by families priced out of Los Angeles, as well as investors seeking cheaper land. Now, with traffic congestion worsening, wildfire threats rising, and builders adding new supply at the edges of the metro, the resale market is struggling. Investor behavior has flipped. Many who bought in 2021 or 2022 are now selling, in some cases at a loss. Reports show open houses drawing fewer buyers, with properties lingering unsold for weeks. Historically, Riverside grew rapidly when Southern California's coastal markets overheated, but it also slowed quickly when affordability hit a wall. Analysts predict further softening through 2025 unless borrowing costs ease, making Riverside a city to watch in California's correction cycle. Chapter 4. Bakersfield. Bakersfield, once considered one of the last bastions of affordability, is also under pressure. The median price sits near $385,000, down about 1.7% in the past year. Inventory has grown by nearly 48%, while wages remain stagnant. With average household incomes below $60,000, mortgage payments of $2,800 per month stretch budgets beyond sustainability. The local economy is part of the challenge. Agriculture and oil dominate Bakersfield's workforce. Both sectors face long-term uncertainty. Drought threatens farming, while state policies are curbing oil production. These pressures reduce job stability, discouraging new buyers. Insurance adds another layer. After a series of wildfires and drought-related risks, coverage costs are climbing. That further discourages entry-level buyers who once saw Bakersfield as an attainable step into home ownership. Investor appetite has also cooled. Rents have stabilized, leaving landlords with thinner profit margins. About 35% of listings now carry markdowns. Analysts suggest Bakersfield's market will not collapse outright, but its affordability advantage is evaporating. By late 2025, further price declines are likely as households weigh the cost of living against stagnant incomes. Chapter 5. San Jose. San Jose, the beating heart of Silicon Valley, has long been one of the most expensive housing markets in the country. But in 2025, cracks are visible. Median prices peaked around $1.4 million, but reports show declines of 1.2 to 2% year over year. Inventory is up 35%. And nearly 30% of listings are discounted. The tech sector, once the driver of relentless demand, has turned into a source of risk. Layoffs at companies like Google and Meta have shaken buyer confidence. Remote and hybrid work options allow employees to relocate to more affordable states, reducing the urgency to buy in San Jose. At today's mortgage rates, a $1.4 million home requires more than $9,200 a month in payments with taxes and insurance. Even well-compensated engineers are cautious. Historically, San Jose's housing prices tracked tech cycles. During the dot-com bust in 2000, values fell sharply. After the 2008 crisis, recovery was slow until the tech boom reignited demand. Analysts suggest the current correction will not be catastrophic, but it could extend into 2026 as affordability remains out of reach for many. Chapter 6. Ventura. Ventura, perched between Los Angeles and Santa Barbara, has always attracted buyers seeking a balance of coastal charm and relative affordability. But the math in 2025 no longer works for many. Median home prices are around $820,000, with growth flat at just 0.4% over the past year. Inventory is up 41%, and a third of listings now feature price reductions. At current interest rates, mortgage payments surpass $5,600 a month. Insurance premiums in wildfire and flood zones have risen 20 to 30%, leaving many middle-income families unable to buy. Tourism, which boosted short-term rental demand, has slowed. New restrictions on Airbnb-style rentals further cut investor interest. Local reports show some landlords selling properties after profits collapsed. Ventura's housing cycles have historically been less volatile than the Bay Area's, but affordability walls now limit growth. Analysts forecast a gradual correction through 2025, with the potential for steeper drops if rates remain high into 2026. Chapter 7. Oakland. Oakland, long marketed as San Francisco's affordable neighbor, is undergoing a reset. Median prices now sit near $767,000, down 6% year over year. Inventory has surged almost 50%, while 42% of listings are discounted. At current borrowing costs, a typical Oakland home requires nearly $5,400 per month to finance. That level, combined with concerns over rising property crime and slower economic growth, has pushed buyers away. Neighborhood disparities are growing. Areas like West Oakland and Fruitvale are seeing sharp cuts, while Rockridge and Piedmont remain stronger but still downward trending. Even condos, once popular among younger buyers, are stagnating. Oakland's history shows periods of rapid appreciation followed by corrections. The post-2008 recovery was fueled by spillover from San Francisco, But with tech hiring slowing and remote work reducing the need to live nearby, demand has thinned. Analysts expect Oakland to continue resetting through 2025, offering leverage to buyers for the first time in years. Chapter 8: Sacramento. Sacramento was the star of the pandemic boom, as Bay Area buyers moved east in search of space and lower prices. But 2025 data shows the shine is fading. Median prices hover near $495,000, down 2.5% from 2024. Inventory has surged 46%, while more than a third of listings have markdowns. Homes that once sold in bidding wars now sit for 35 to 45 days. Payments on a typical Sacramento home are about $3,800 a month. For a workforce dominated by government and healthcare jobs, these costs are stretching budgets. Investor activity has slowed as rents plateau, and stricter local rules on short-term rentals have reduced Airbnb profits. Historically, Sacramento lagged coastal markets by a year or two in both booms and busts. After 2008, values dropped significantly before stabilizing. Analysts say 2025 looks more like a reset than a collapse, but they expect prices to soften further into 2026, giving patient buyers their best entry point in over a decade. Chapter 9: San Diego. San Diego has long been one of California's most desirable markets, thanks to its climate, beaches, and lifestyle. But even paradise is not immune to affordability constraints. The median home price stands around $875,000, down 2.1% year over year. Inventory has exploded 61%, with more than 6,000 active listings compared to 3,800 a year earlier. Nearly 40% of homes are discounted. Average days on market have climbed past 40, compared to less than 2 weeks during 2021. Monthly mortgage payments exceeding $6,000 are far out of reach for the region's median household income of $85,000. San Diego's economy remains diverse: military, biotech, and tourism. But even these industries cannot offset affordability fatigue. Investors are also retreating due to new rules restricting vacation rentals. San Diego's last major downturn was in 2008, when prices plunged 35% before slowly recovering. Analysts do not expect a repeat on that scale, but they forecast a steady correction through 2025 and into 2026. Chapter 10: San Francisco. San Francisco, the crown jewel of California real estate, is facing one of its sharpest corrections in years. Median prices are now about $1.12 million, down 3.5% year over year. Inventory is up 43%, and more than a third of listings have markdowns. Homes that once attracted 10 or more offers now sit unsold for 45 to 50 days. Mortgage payments top $7,500 a month before property taxes and HOA fees. Combined with ongoing concerns about crime, homelessness, and quality of life, many buyers are opting out. The pandemic also accelerated migration away from San Francisco. Remote workers moved to states like Texas, Idaho, and Arizona, where homes cost a fraction of Bay Area prices. With fewer people rushing back, demand has cooled. Historically, San Francisco has always rebounded from downturns, thanks to its global role in technology and finance. But analysts suggest the city is no longer untouchable. Corrections are likely to continue into 2026, especially in the condo market and fringe neighborhoods. California's housing market in 2025 is defined by correction. Across cities large and small, inventory is rising, affordability is collapsing, and sellers are scrambling to adjust. For buyers, the shift means leverage. For sellers, it means facing the reality that the days of endless bidding wars are gone. Which city do you think will see the steepest fall this year? Share your thoughts in the comments below. And if you found this video helpful, don't forget to subscribe to Global Lens for more updates on real estate, economics, and global living trends.